Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Stocks stalled on Thursday as Wall Street digested a much hotter than expected PPI inflation print, souring optimism around a large September rate cut. At the end of Thursday's session, all major indices ended the day flat. And more retail investors are playing the market, and we have data to see the top tickers they're buying and selling. We're taking a deep dive on that. And the Trump administration could sell its stake in Fannie Mae and Freddie Mac through a public offering. We're exploring what public trading of the mortgage giants would mean for investors after years of government conservatorship. Well, American workers are increasingly invested in stocks. We know that in their retirement funds. Vanguard Group found workers in their late 30s had 88% of their 401ks in stocks last year. That's versus 82% a decade earlier. And a new sentiment survey from Investopedia shows retail traders, they're more interested in individual names than ETFs, with the data showing if folks had 10,000, 22% of respondents would put that money into individual names. Caleb Silver, Investopedia editor-in-chief, he's with me now. Caleb, let's start. I want to know how Investopedia fans, how are they feeling? What's the vibe there?
The vibes are strong. The vibes are immaculate. Record highs will do that to you, right? And we've had a lot of them lately, and they see this deregulatory environment. They see the fact that rates are coming down, and they've seen some outperformance, not just in their favorite stocks, which look a lot like the top of the S&P 500, but in a lot of smaller stocks as well. So they've been paid for their patience, they've been paid for hanging in there, and they've been more aggressive by and large than a lot of institutional investors. P.S. Institutional investors, according to Bank of America's most recent fund manager survey, also as optimistic as they've been in 6 months. But again, higher highs will make you feel pretty good.
So good vibes. What are they doing with those vibes? What are the names they want to own?
Yeah, they own their home cooking. They own the stocks that they've owned ever since they probably got in this game, and that is the top of the S&P 500. NVIDIA tops that list. Palantir, new but rising onto that list. Microsoft, Apple, Amazon, of course. You see some Berkshire Hathaway in there. You see a little Costco sprinkled in there and some banks like JP Morgan. But by and large, mega cap tech, anything AI related of size, they stick with them. They've been paid well and handsomely for sticking with their bets.
Now, another question you ask, which I always think is interesting, you also ask, hey, what do you want to own 10 years from now? What was their answer?
Yeah, well, a lot of the same stocks. NVIDIA is on the top of that list as well. Palantir, one of the top stocks on that list as well. Microsoft, I see there as well. Even Alphabet. So not a lot of change, because why change when we are really in the land of the giants? The big stocks move the market. We were talking with a guest earlier that says they are the market. If you're not in these big stocks, you're not just moving, you're not having that outperformance. So they have to be in them, and they've been rewarded, again, for holding these stocks. You don't see a lot of them exploring a lot into other sectors beyond big tech right now and beyond smaller stocks, but you do see them globbing onto the same things that have delivered the performance, that look like the QQQs, that look like the SPYs. That's where they stuck their money. That's where they intend to stick their money. And as the market has been rising for the past couple months, that's where they put even more of their money.
And you also asked them, I like this part of the survey, you asked them, listen, if you had an extra 10 large, an extra 10,000, where would you put it to work? Where would you commit capital? What was their answer?
Yeah, this is the ultimate discretionary question. What would you do with an extra 10,000, assuming you could invest it and individual stocks top that list? And when you have this rising bull market and records after records coming in day after day, that's what you get. They want to own the individual names because that's where their performance has been. Second on that list is ETFs. They want some diversification there. That makes a lot of sense as well, but basically keep buying the same stocks that have delivered the returns and that have made them 401k millionaires. And when you look at survey after survey, we have more than ever right now. As you mentioned, Vanguard saying more and more people contributing stocks to their 401k plans. We are a stock-heavy nation.
If you ask them some of these questions, let's say 6 months ago or 12 months ago, has there been a big difference? I mean, has it evolved a lot?
Absolutely. And they went from trying to be safe with CDs and high yield savings to back to stocks, back to ETFs. So you see that seesaw depending on behavior and depending on how the market's doing right now. When we had the big sell-off, everyone was running for cover. There was gold was topping that list as well. But they were looking for places to be safe. ETFs were a little bit stronger than individual stocks because of the diversification. They'd seen some big tumbles in some of their favorite stocks. But when you get a bull market like this, when you get records after records, people want to own individual stocks. Again, biggest stocks in the market just keep getting bigger.
And when we talk about the folks you're surveying here, remind me, Caleb, the Investopedia fan, who is that fan? What's the demo?
Yeah, the Investopedia reader is Right here, you and me, right? 18 to 80, self-directed, educated investors who like to invest their own money. Maybe they also get professional advice to do it as well, but they're interested in learning how this works, and they come to us to get smarter about it. But we're talking about, adults, average age in their 40s or so, but we do have this big range of people who are just starting to learn to people who are kind of nearing the end of their investing journey but still want to stay smart. So this is kind of everybody, and it's a pretty good representation when you think about the size of our reader base.
Caleb, I always love having you on the show, especially on set.
Thank you for having me, and I got a question for you.
Yes, sir.
Should be a question for you, see if you've been following things around the world. What is the best performing regional ETF, country ETF around the world, and what's the worst so far this year?
So here's what I love about this question, because we talk about the melt up in the US, as we should, but actually a lot is melting up, right? So I don't know the answer, fill me in, but I love the question.
I'd love a guess.
Yeah, I'd go Germany.
Yeah, it's in the top 5, but Greece and the Greek ETF, GREK, up 73.6%.
Why Greece?
Year to date. A little bit immune from the tariff issues, right? Except for maybe Saganaki and Uzo, but also kind of immune and not really involved in any of this mix-up. And I think maybe potentially benefiting from the fact that, maybe some tourism, but sometimes you don't know why some of these regional countrywide markets do so well. The worst?
Yeah.
Saudi Arabia, down 6.7%, a good proxy for oil prices and gas prices right now. But we do talk about American exceptionalism. 2025 has been a year where we've seen the outperformance of markets around the world, from South America all the way over to Eastern Europe. Poland used to top that list. They are second in terms of best performing ETF, followed by Spain, Austria, Vietnam, and then you get to your Germany.
Greece and Saudi Arabia. Great seeing you, my friend.
Thanks for having
me. Fellow Colgate guy. Go Raiders. The market rallying, stalling after new data showing wholesale prices rising higher than expected in July. For that and other trading day takeaways, let's bring in now Yahoo Finance senior reporter Allie Canal. Allie.
Yeah, but despite that PPI print, we basically saw markets close flat. The S&P closing slightly above the flat line. That means we have a new record high. So in a lot of ways, it feels like markets are digesting this news and basically accepting the fact that in the near term, we're going to be seeing some increased inflation. However, the why is very important. So we did see producer prices hit a 3-year high, coming in way above expectations. But we did see services, those components, rising for PPI. This is similar to what we saw with the CPI print the other day. And that's a problem for the Fed, because even if they look through tariffs as a one-time price increase for goods, if services is rising, we're a predominantly services-oriented economy, that means something else is happening under the hood. So that is what economists have been talking about today, and that's really the main pain point looking ahead. Still, markets continue to expect the Fed to cut interest rates. We are just around 90%. Didn't change all that much, maybe a tiny bit less conviction, but overall, there seems to be this expectation that come September, we are going to get an interest rate cut. The general consensus seems to be if we do see a rate cut, it's going to be 25 basis points, not a jumbo 50 like we saw last year. And the market environment is a bit different now too, right? I mean, interest rates are 100 basis points lower this time around than they were last year. We still have that weakening labor market, but the immigration controls, that's something that the Fed is going to have to take into account as well when we look at that unemployment rate.
Yeah, so basically it's like, markets looked at the CPI print, the PPI print, and said, okay, there's nothing here that derails that cut that they bet is coming next month.
Right, and it'll be interesting to see if we don't see the Fed cut, and we've been having different opinions there from actual Fed officials. They've been coming out and speaking, and not everyone is convinced that they need a cut.
It is interesting to your point, you think some maybe would be leaning harder into the cut than they sound like they are.
Yeah, they really much seem to be on the fence here. So that's something that I'm going to be focused on. We have Jackson Hole next week. Jerome Powell has been very good at telegraphing where he thinks the Fed is going to go. So I could see maybe these rate cut odds changing. But from there, I also want to take a look at crypto, because we know that crypto has been just a big outperformer this year. But today, we saw basically all of the tokens take a leg lower here. Bitcoin down 4%. Same with Ethereum. Now, I will say this comes after Bitcoin hit an all-time high really early this morning. Maybe it's some profit taking. Maybe it's the fact that we were a little...
Treasury Secretary Bessent made some headlines too.
Yeah, maybe we're a little more risk off in markets overall as well. But still, if you take a look year to date, Bitcoin prices have just been on an absolute tear. And this comes as the administration has really embraced crypto at large. And it's not just retail enthusiasm, it's the institution side as well. We've seen really successful IPOs with stable coins. Really any company that touches crypto, touches tokenization, they've done really well. Bullish too, it's a crypto exchange owner. I believe that stock closed up around 9% today after that successful IPO. So overall, even though the rally fizzled a bit today, I think there's still a lot of tailwinds moving forward.
And Trump and that friendlier regulatory backdrop, that's not hurting either, right?
You're right, exactly. And then finally, let's take a check on market breadth. So this is something that we're continuing to watch as we really monitor this market rally. And yesterday, we saw small caps rise about 2%. That's the Russell 2000 index. This was the highest level that we've seen in about 6 months here. And if you take a look at a year to date, you can see this steady rise up. Now today, the equal weighted S&P 500 underperformed the benchmark S&P. So this shows us that most of the smaller companies, they weren't doing too well today. We really saw those large cap companies leading the way higher here. But overall, that's starting to narrow. We are starting to see more broad participation. And that is really critical when we talk about the sustainability of this rally, because you don't want a market that is really top heavy and just concentrated in those top 7 names. You really want a lot more dispersion there. And we have been seeing that over the past several months. And you can see here, year to date, we're up around 6% for the equal weight.
Yeah, we had Caleb Silver on the show today. I asked him, what are the vibes like over at Investopedia? Strong, he said. And there you go. That helps.
A lot of optimism.
Thank you. Thank you, Allie. We've been reporting that the Trump administration is considering selling the U.S. government's stakes in mortgage giants Fannie Mae and Freddie Mac, but it would have complex implications. Our data and markets editor Jared Blickery breaks it down for us in his recent episode of Stocks in Translation.
President Trump is moving closer to taking Fannie Mae and Freddie Mac public, an IPO that could raise about $30 billion for taxpayers and start unwinding their 2008 conservatorship. And in this Stocks in Translation episode, we're going to explain who they are, why this matters for your mortgage, and what an IPO would and would not change. Both Fannie and Freddie, they are GSEs, that's government-sponsored enterprises, which are private companies that are chartered by Congress to keep credit flowing in a key market like housing. Fannie Mae was born all the way back in 1938 to keep mortgage money flowing after the Great Depression, and Freddie Mac, it arrived on the scene in 1970 to boost competition and liquidity in the market for mortgage trading. Together, these two giants have touched about half of all outstanding mortgage debt in the U.S., which keeps the lending pipeline open. And after these mortgages are bundled together, Fannie and Freddie help anchor the prices of those bonds. They also help make 30-year fixed loans possible by buying loans and guaranteeing mortgage bonds, which lowers costs for lenders. Thanks to them, U.S. mortgage holders save about 10 basis points on their rates on average. Not huge, but the savings compound and they grow over decades. Now, here's a timeline that starts with the global financial crisis. In 2008, Fannie and Freddie were put into conservatorship, into the care of the U.S. government. In 2010, they left the New York Stock Exchange, but continued to trade in the less liquid over-the-counter market, or OTC. That's why we have stock prices for the last decade. From 2012 on, most profits were swept into the U.S. Treasury to the tune of $300 billion by 2019. These actions ignited a decade of lawsuits. Then from 2019 to 21, policy shifted a bit to let them keep earnings and also rebuild their capital as a buffer. Now here is a chart of Fannie Mae since the late 1980s, and notice the huge run-up into the middle of the chart around the global financial crisis. Also notice the big drop. Freddie Mac's chart looks almost identical. Neither stock did much for a decade, but some titans of Wall Street, they did amass big stakes, like Bill Ackman's Pershing Square hedge fund, and also John Paulson, who famously bet against housing over the GFC. You can see this stock has recently come to life right here, but the prices have been swinging mainly on policy headlines and court rulings, not on traditional fundamentals. Bank expert Chris Whalen of Whalen Global Advisors recently appeared on Yahoo Finance and hammered home some key points. Let's take a listen.
First and foremost, the government has to get paid. So what it's going to mean is that the existing shareholders are going to be massively diluted. The federal government will probably end up owning over 90%. They will always be backed by the Treasury. That's the reality.
If the IPO goes forward, these two mortgage giants could be worth over $500 billion combined. So it's important to spell out what the IPO would do and what it would not. An IPO means new shares, new capital, and likely a major exchange listing. But as Whalen just said, the government backstop will likely continue unless Congress rewrites the law. That's actually good for mortgage rates. And in case the giants are restructured or wound down, the Treasury gets $355 billion before anyone else. And all the dividends already paid, they do not reduce that tab. If you're shopping for a new mortgage, the IPOs are not going to affect you too much unless there's a big unexpected change. And for stock investors, it's a bet on the health of the U.S. mortgage market, but subject to huge event risk. The big movers are going to come off headlines in the press and also from the courts. At the end of the day, this story is about capital, terms, and your mortgage cost, in that order. If the plan is clean and credible, the housing pipeline stays stable and investors, they get clarity. If it's messy or delayed, expect volatility in the stocks and more volatility in mortgage rates in general. Tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.